this is one of these topics that I feel that I listened to a lot of hand wringing about over the last decade that I mostly ignored because, yes, the US debt kept growing, but I didn't think that there was any reason to believe that that was going to cause impact tomorrow. It hadn't for years, so why was it going to do anything tomorrow? So I just sort of ignored it. Now we're a bit of a different point, which that point is that China's buying far fewer treasuries. Russia's not buying any treasuries. Japan's not buying treasuries to the extent that it was because it's managing its monetary mess in a different way. It's yield curve control. It's doing it in a different way. US banks aren't buying treasuries to the same extent that they did because so many people have taken their money out. They're having capital drain from banks. And so because people are putting their money into money market funds to capture these high rates. So much of the big buyers of US debt aren't buying the way that they have been for the last 2 decades.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. And we do that by simplifying some of the most complicated information for the average person. I'm your host, Darrell Thomas, and today we're in for a treat as I am interviewing Gwen Preston of the Resource Maven. Gwen has been a journalist in the mining sector for a long time, for over 15 years, and she comes with a wealth of knowledge about resource investing and determining the value and potential for different mining companies. She's very bullish on the natural resource sector, so I'm glad to have her on the show today. I will be linking her YouTube channel as well as her Substack in the description below, so be sure to subscribe and show your support for her. Now, take a look at this statistic. So over 91% of the people that watch my channel over the course of his lifetime have not subscribed. So be sure to hit the like button and the subscribe button. It doesn't cost you anything. However, me offering this content costs me time and money. So I'm not going to get long-winded and talk your ear off even more. So without further ado, let's get to the interview. All right, everyone, we are here with one of the champs. I call her a silent champ because I didn't know she was a champ until I started doing my research. Gwen, how are you doing today?
I'm doing very well. How are you?
Doing good, doing good. We had a good chaotic time on Bourbon Street, but I think it was
There's no other way to have a time on Bourbon Street. It is always chaos.
For the first time, it was kind of overwhelming. You know, it's like, okay, yep, this is kind of interesting. Let me
Exactly.
I'm kind of head on the swivel type guy. I'm looking out for my folks and like making sure nothing pops off and things like that. So it's but it was fun. You know, it's good to be able to kind of relax and enjoy the people around you. So
absolutely.
So yeah, I wanted to bring you on today to have a talk about your recent newsletter article through your Substack. And so I'm going to go ahead and share screen so I can show that article here, which it was a good title. It says, "No simple headline for this mess." You go into depth about the bond market and what's happening there. And anyone, if you haven't subscribed yet or checked out Gwen's content, be sure to check that out because she's, just very intelligent, even just how you laid all of this out. And so you talked about the bond market. So there's been a lot of talk about obviously locking in your money at 20, 30 years can be kind of risky at this point. We do see CPI going down. Obviously, they changed the numbers up on people. Changed how they calculate it, and you laid it out here in one of the charts where you talked about how core CPI and the other measures are even factoring in. Some of them exclude food and energy and things of that nature. And so, what's your take on like investing in bonds? I mean, we're hearing these different stories. I mean, you can Fed cuts rates, you can get a higher return, 4%, 4.5%, because inflation is going to go down and the Fed's going to cut rates. But then you also have this risk of like energy prices going higher because of lack of supply. So you got this whole supply demand thing. So how do we make sense of this mess?
That's a big question. I'll do my best to tackle it without taking an entire hour just on one question. I mean, so the context here, as I'm sure most of those who are listening are well aware, is that we had a very, very long bond bull market, right? Yields went down and down and down and down for ages. And then we had COVID, and then we had, the subsequent inflation, and then we had a seismic shift in the bond market. Yields broke up. They broke out of that long downward trend. And that has really changed the game in the bond market. So then, of course, the question is that going to persist? Where are we going from here? The answers to that are all very big picture, right? That everything to do with what bonds are doing has to do with government debt, and it has to do with inflation, and it has to do with GDP. And so there's no way to talk about this without talking about really big topics. So the biggest questions amongst that are we going to get a recession, and what's going to happen to inflation? Because both of those can on their own answer this question. So if we were to get a recession, and there's certainly data points out there that suggest that we're heading that way, we aren't there right now. And there's been data points suggesting that we're heading that way for a while, and we're still not there. But that evidence persists. So it's absolutely still a possibility. If we head into a recession, rates will get cut, and that will pull bond yields down, at least for a while. And that's one thing that could answer the question for the near term of what's going to happen with the bond market, which is that yields would come down and prices would go up. That's if we get a recession. The other thing, like you mentioned, is inflation. If inflation continues to come down, which the trend looks pretty good right now, like you say, energy, I think, is the big question mark in that trend. And it moves to its own drum, so to speak. So it's hard to sort of wrap it in the same consumer sentiment package that we talk about a lot of the rest of the macro, the US macro picture. But if inflation continues to trend down, and unemployment is sneaking up, it really is. It's up 0.5% in, 6 months. That hits Sham's rule, or Sam's rule, Claudia Sam's rule, which is when unemployment increases by 0.5%, using year-over-year measures within, I think it's a 3 or 4 month time frame, then a recession is coming. We've hit that point, or we're very, very, very close to hitting that point. So those two things, unemployment and inflation, are the only things that are supposed to determine the federal funds rate. So if inflation continues down and unemployment keeps even just slowly ticking up, that erases the Fed's argument for further hikes. So if those trends continue, then we get rate cuts. So both of those things, the way they're set up right now, suggest that rates have probably topped. Like I said, energy is an outlier question. Inflation could tick up again, although right now it looks pretty, that looks like it's not going to happen next month. So our bond, that means that rates are likely to come down. The other huge factor that comes into play, though, is just US debt and deficit spending. And this is one of these topics that I feel that I listened to a lot of hand-wringing about over the last decade that I mostly ignored, because yes, the US debt kept growing, but I didn't think that there was any reason to believe that that was going to cause impact tomorrow. It hadn't for years, so why was it going to do anything tomorrow? So I just sort of ignored it. Now we're a bit of a different point, which that point is that China's buying far fewer treasuries. Russia's not buying any treasuries. Japan's not buying treasuries to the extent that it was, because it's managing its monetary mess in a different way. It's yield curve control. It's doing it in a different way. US banks aren't buying treasuries to the same extent that they did, because so many people have taken their money out. They're having capital drain from banks. And so because people are putting their money into money market funds to capture these high rates, so much of the big buyers of US debt aren't buying the way that they have been for the last 2 decades. And that matters, because the US government runs on deficits, And the deficit needs just keep increasing. And when we saw a couple of weeks ago, the Treasury came out with its expected issuance calendar for the next few months, it was slightly lower than expected, but in the statement, it said, translated, it said, we're going to need to re-up it again soon because this just isn't going to cut it. We actually need more debt than we're issuing, but we're worried that we're not going to get met on these asks. And that's the big thing to look for on that US debt. Is it actually going to have an impact? Is it going to cause chaos soon? What you have to watch for is the bid cover ratio on those Treasury auctions. So if there aren't enough if we actually get to the point where there aren't enough buyers for a Treasury auction, then we get to a structural problem in the Treasury market. And the Treasury market is the biggest, most important market in the world. Absolutely. So if we don't have enough demand for the notes that the US government has to issue to fund itself, then we get to a point where bond prices might just keep going down and yields might keep going up, because that's what happens when you don't have enough demand, price goes down. So those are the big things. Is there enough demand for treasuries? What's going to happen to inflation and unemployment? And is there a recession around the corner? Those are the three variables that will determine what happens to bonds going forward. I don't have a crystal ball. Wish I did so many times every day. But I don't think that the bid cover ratio, the bond cracks in the bond market are going to flare up in the next few months. So I don't think that that's going to be a thing right now. It's not going away, but I don't think it's in our face right now. I think that inflation is headed down and unemployment is headed up right now. So I don't think the Fed is going to raise rates right now. And the recession warnings are there. They've been there for a while. Again, I don't think it's sort of a huge factor, but right now I think we're not going to see rates go up. Yields might come down. People might want to lock some money into long term because, heck, you get some great yield and prices might appreciate over the time that you own them. But there are big forces at play here.
Yeah, and that's kind of like I wish you did have the crystal ball, and for everyone watching, loaded questions come with loaded answers. So let's unpack it even more. But yeah, so so one thing, with locking away money for that long, we went so long without inflation in the picture. We went, 40 years or so without inflation, becoming more sticky like how it is now. And then we've been at that zero bound for a while. Interest rates have been on the decline for a long time. And there's the historical narrative of the government allowing inflation to run hot to reduce the debt. Obviously, the government can't continue to borrow at these types of rates, at these levels, continue to increase its debt at high interest rates, and so it's that creates a whole other issue as well. And so I did have a question on recession. So the data points are pointing to it. Some people are saying recession's already here, and the government's going to look in hindsight like, oh, we did go through a recession, and we've had that before. But then it's also, some people are like anticipating a bigger event in terms of a huge drawdown in equities, which, in this article you share about the Magnificent Seven holding the market up, but the rest of the equities are still been getting clobbered. So it's kind of interesting in how to measure, okay, is a recession like a one-time event, or is it a process, and are we already in the middle of that process? Obviously we've had positive GDP numbers and things of that nature. And so are you more leaning towards we haven't seen it yet, or are you thinking that we're already witnessing some evidence of that already happening?
Yeah, so I guess what it comes down to is what aspect of what makes a recession matter, right? And what makes a recession matter is a significant increase in unemployment, because then people don't have money. And we know that the US economy is 70% consumer driven. So people having money is essential to maintaining the economic growth, or just keep it to just sustaining it. So a significant increase in unemployment, and then a significant decrease in the stock market. And that's because financial assets really matter. When people feel like their 401k or their whatever investment account is looking good, then they're more likely to spend. Brings us right back to that. We are a consumer economy. And so growth really depends on people having money, and that comes from jobs and from investment accounts. So at this point, like I said, we're seeing that unemployment rate creep up, and with some like a sustainable rise. Certainly it isn't at a point now that is worrisome. I mean, most people who want to get a job can still get a job right now, and that really matters. And we certainly haven't seen a significant correction in the stock market. Like you noted, there's 7 stocks that are holding the whole market up right now, and the S&P 493 is flat or down for the year. So it's a weird market, and there's historical examples of how this doesn't likely last. Like we go back to the tech bubble and, tech stocks diverging so significantly from the rest of the stock market. Well, it certainly didn't last back then. That bubble had to burst. Is this a bubble? What are the real valuations for these massive tech companies that are truly so integral to our lives right now? I don't have answers to these. I do think that, whoa, I like that my light just decided to start like flashing rainbow colors on me. That was fun. Let's turn that off.
That's a good sign.
So rainbows over here. I do think that it's interesting to me that we keep getting reliable recession indicators. It's like they're taking their turn. Like, of course, we had an inverted yield curve, and that was a big conversation for a really long time. Right now we have that composite that's called the leading economic indicators. They have fallen at a rate that never before has not led to a recession or predicated a recession. So we keep getting, and like those are just 2 examples. There's been quite a few, this indicator, that indicator, the other indicator that keeps suggesting that we're going towards recession. So we're going to get one. The question is whether it's the kind that matters, whether it's the kind that leads to significant unemployment and a stock market correction. And at this point, I don't know the answer to that. The stock market is a different beast because there's so much passive investing now. And passive investing is not trying to predict value. It's not trying to seek, or it's not trying to predict future moves, nor is it trying to seek undervaluation. It's just owning what everybody's owning, right? It's just momentum. And that perpetuates a situation in a way that that's a force that has never been at play in the market anywhere near to the extent that it's at play right now. So that's really changed the game for, I think, what the stock market is going to do. And because we're so stock market focused, I think that's drawing things out. Whether it will draw things out strongly enough to just carry us right past this weakness that all the indicators keep pointing to, it's possible. It's been happening so far. At the same time, we could see some kind of interest rate impact. And I know this is another conversation that has been on and on forever, but like that was a ridiculous rate hike cycle. Mm-hmm. And people are not used to interest rates at this level. I mean, I had a conversation just the other day with a friend of mine who's a successful investor. And he was like, I think my sister's going to lose her house next year because she had a variable mortgage for years and did really well with that for years, paying hardly any interest on her mortgage. And he's like, but she didn't put the money that she was saving, or, the extra capital that was available to her. She didn't put that into her house. She, as he said, bought toys and went on trips. And now that those decisions are coming back to haunt her, and she might lose her house. That individual situation is cropping up everywhere. It absolutely has to be, because that's what rate hikes do. They're real. They impact our debt, and we are a very debt-heavy society. So the chance so I feel like the stock market momentum factor could carry us through, except for the risk that some sort of debt crisis happens, whether that's a household situation, whether that's small businesses that can't roll over their debts. I'm not sure, banks having overexposure to bonds. I don't know which it might be, but that risk is real. So I think if we're going to have a recession, it's going to be sparked by some kind of interest rate impact crisis. And that's what's going to break the momentum that passive investing has given the stock market to just carry on. So it's unfortunate. Again, I wish I had a crystal ball to tell you when or how that might play out. But that's the way I see it.
Yeah, that's good. Yeah, because even thinking about it practically, when unemployment increases, people take money out of their retirement accounts. They take money out of their stock accounts, their investment accounts, and things like that.
Exactly.
And that can have huge drawdowns as well. And so
yeah.
I definitely see that. So in terms of buying U.S. debt and financing the government, running a $1.72 trillion deficit, and this has to be financed somewhere. So who buys the debt? Is it the Fed? Does the Fed eventually reverse course and have to increase their balance sheet, tenfold or whatever to finance the spending? I don't see any politician going to cut Social Security or Medicare or military spending. I mean, it seems like we need to be investing more into our infrastructure, our resource production, all those different things. But who ends up financing this? And that's probably another loaded question, and it's not black and white, but would just love your insight on that.
I mean, you've absolutely pegged the issue, right? Which is that there's no practical, realistic way to see spending cuts or tax increases in the United States, right? The two sides will oppose those. And so the deficit spending has to continue. And so then you're reliant on, and of course, this is all set up on the petrodollar and the fact that the US dollar became the reserve currency of the world. And so for a long time, that absolutely was possible. You could just have as much debt as you wanted because there was an endless pool of buyers. Now that pool is still incredibly deep. Okay. There's a huge number of international corporations, governments that need to own US debt. Like, yes, it's easy to point to some big buyers who are buying less: China, Russia, Japan. But that doesn't mean that the US Treasury market is suddenly super tight. It's still the biggest market in the world. It's still an incredibly liquid market. Yes, the buyer interest level is slowly declining, right? And that is a path that we're on. And I think, like I said at the beginning, for a long time, I totally ignored it because I was like, we're so far from whatever point that path is leading us, that it doesn't matter yet. We're getting closer to that point, to the point where something's got to happen here or something's got to give. I don't think we're there yet. We still have reasonably good bid cover ratios. China's still buying debt. Like, it's still happening. There isn't an answer. Your question doesn't have an answer. There's no one to step forward and buy that debt. The answer is there's no one. And so when you get to the point where they're issuing debt and no one's stepping up to buy it, that's when the system is broken. That's when the US government doesn't have money anymore. That's when, inflation spirals and the US dollar depreciates, and it's the end of that reserve currency setup. That's the answer. That's a huge answer, a huge point, of course. And like I say, we're not there yet, but we are stepping decidedly closer to it. And that is certainly one of the reasons that gold is doing very well these days, and it's stayed strong all through the interest rate hike cycle, which it officially wasn't supposed to do. And it's because there's so many, especially countries out there, that see this coming, whether it's 2 years from now, 5 years from now, 10 years, I don't know, but they see a seismic shift in how the world transacts, and the US dollar being less and less a part of that foundation. And what's the alternative? Well, we're not going to use the renminbi. We're not going to use the yen. We're not going to use the euro. So gold is the only obvious, it's part of the answer. It's not the answer. It's part of the answer. So I said in my talk in New Orleans, and I love to point out, there's this cool chart from the World Gold Council that shows central bank gold buying. And absolutely, it's going up and up. So that is really interesting. And it has spiked significantly over the last few years. But what is really interesting within that is that it shows disclosed versus non-disclosed central bank purchases. So the World Gold Council knows the central banks that are buying and selling, but the central banks can tell the World Gold Council whether to make public their transactions. And over the last few years, as the amount of central bank buying has really increased, the majority of that increase is not disclosed. So that's a whole bunch of countries, the BRICS and BRIC plus countries, quietly, covertly accumulating a lot of gold. They don't want to be out front about it because they don't want to be like, the sky is falling. They don't want to be Chicken Little, but they nonetheless want to be prepared. So they're buying gold and tucking it away, and they don't want people to know that they're doing it. So I think that's a really solid piece of evidence in the group of arguments that this is really happening.
Yeah, I think it was Dominic Frisby that had mentioned that in his presentation as well, where China has, you look at the chart of how many countries have how many tons of gold, and the United States is still at 8,000, but that hasn't been audited and things like that. And so the numbers can be skewed. And so I'm glad that you mentioned the World Gold Council having disclosed and non-disclosed central bank buying. So for the price of gold right now, I believe that the price of gold is not higher because of the U.S. dollar still being stronger. So I just interviewed a friend of mine in Argentina who's experiencing over 100% inflation. I think a number that I heard just the other day was 200% over the last, I think, month. And we were talking about her experience and what people are able to buy. One minute they can buy one thing, and the next minute they can't buy it, with the same amount of money. And so I mentioned gold. I said, are they able to buy gold, or what are they storing their money, their value? How are they storing value? And she's like, buying gold is a dream, is a dream down there. And so, do you think that the U.S. dollar, because gold has been at all-time highs in multiple other currencies, is it the U.S. dollar that's keeping pretty much gold at, not breaking through this 2,000 level? We're at a triple top now. Is it the U.S. dollar, do you think?
The U.S. dollar absolutely is playing a role in it. And of course, that just brings us right back to all these massive, massive economic questions. So that's sort of a frustrating answer, because what are you supposed to do or expect on that front? I think the other factor for gold is that is a lack of impetus on the part of retail investors to seek change to change their portfolios. Sure, things were flat in 2022 and things have been but then in 2023 they've been up again, and it's that Magnificent Seven and passive investing just continuing to move the market. And as long as that continues, and now inflation's coming back down, which is perhaps reducing something that might have encouraged some people to go towards gold. As long as 401ks keep growing, then, and a huge number of the funds out there are just passive, they're not actively managed, then why would they bother looking for value elsewhere? And as a gold investor, that's almost sort of a sad thing to say, because I want people to realize that there is risk out there, and I want them to move towards gold, but I don't really want it to happen because there's some sort of stock market calamity or debt crisis. I don't want to wish for that, but I do think that complacency is keeping people invested in stock market indices, and that is just eating away at whatever interest might otherwise flow towards gold. So I think it's both of those. The US, you're right that gold is doing much better in other currencies. And of course, currencies are all just a relative game, right? If the US dollar is strong, so the other currencies are weak. So that makes the gold price look higher in those currencies. So those are all just relative. So that's absolutely a factor. But I think it's also just there hasn't been that strong impetus. There's been wars, but anybody who follows the gold price has seen many times that wars are usually a fairly short-term impact on the gold price. So even if that does drive some buying towards gold, that doesn't usually last a long time. The things that make the gold price move sustainably are economic forces. And right now, those are just keeping people in the stock market. And so until that changes, I'm not sure. That said, at some point, all of this central bank buying has to matter, right? There is so much central bank buying, it's insane. And so at some point that pushes the price up, and to a point that it catches attention. And then it goes. And will that be what breaks us out of this triple top right now? It's possible. I don't know when that's going to happen. But yeah, it's just if it ain't broke, don't fix it. That is unfortunately for gold, a lot of investors take on their portfolios these days.
Yeah. And I think also in addition to that, I mean, obviously the longer term trend of the dollar losing its value and gold going up in value, I mean, that trend's still in play. I mean, I just don't see no reversal for the dollar to not continue to lose value. And so that's kind of like another reason why, obviously I hope gold is like, okay, our dollars don't buy as much as they used to. And that's reflected in the gold price. However, I wonder if the 2008, was it 2005 to 2008 or 11 or something of that nature, if that run up, if gold got overpriced because of the FOMO, and then, it corrected to where it should have been, which was, I don't know, what, 1,000, 1,200 an ounce, something like that.
Yeah.
And then now we're seeing like, okay, that we haven't seen the FOMO come in again yet, but now it's like repricing towards 2,000 or so. I want to jump into the mining sector, and I do want to get your thoughts on uranium too. But before we transition to that, while we're on miners, let's our gold. Let's touch on the miners.
Sure.
So for average investors, oftentimes, so I'm invested in some exploration companies. I do have some miners. My conviction on them has been waning. I would say waning as of recent. Like I'm just like I rather own the gold price, because the miners they respond temporarily and then they fall significantly. I mean, gold prices at $2,000 an ounce, and even the big miners have declined recently, and so what's kind of your take on just in general on the mining stocks? I mean, you've been in this game for, I think, 15 years, so you were part of that last cycle, and so what's your take on the miners in general?
So, the characterization that you just used for that last bull market, the 2005 to 2011 bull market, where there was a lot of FOMO, that was very real. I mean, gold and the entire metals complex was ripping higher, and it was a huge focus for investors of all stripes, right? You didn't have to be a mining investor. It was one of the things that everybody was buying. It was the growth of China story. It was all of that, right? And that, propelled interest into the metals. But then, anybody who's interested in the metals, the next thing they do is buy miners, and that pushed it into the miners. And then there's that cascade where people then move into the developers, and then they move into the explorers, and it moves the whole sector higher. That is not happening today, as you very much pointed out. And I think why? I think the first answer is the same that I said for gold itself, which is that the rest of the stock market is handing out easy returns just by owning the S&P. So why would you own mining stocks in particular, right? I think there is a medium-term argument that we're not producing enough copper, silver, nickel, and those prices have to move higher if we want to literally be able to keep building cars and buildings and boats and whatever. But that's not going to happen tomorrow. And it's not going to happen tomorrow because my summary of that is people don't buy base metals unless they are confident that we're heading onto a strong economic growth trajectory. That's not where we stand right now. So nobody's interested in base metals. So that medium term thing exists. I don't think anybody can deny that we're heading towards a shortage in copper, or deny that we don't have enough silver to make all the solar panels that we need. Those are facts, but that's not going to play out tomorrow. So that's the sort of base metal side. It is on hold until the world gets confident about growth. How we get to that point, that's another question. On the gold side, gold has just been holding its ground, right? And nobody buys things for leverage to a price that's not moving. And so what's been the rationale for moving into gold miners? Until we see a sort of clear reason to believe that gold is going to move higher, or see it start to do that. I mean, once that happens, there's a huge catch-up game that has to play with those gold miners for them to return to any kind of historical norm in terms of the what they give, the multiple that they give, relative to the gold price. But there's no reason to see that right now. And then, so that's sort of the generalist thing. And then within the space, there's also this, so there's not a lot of interest in the space at all. The other factor that I like to point out is that junior exploration stocks, the explorers out there looking for a new silver discovery or gold discovery, they used to be almost the sort of speculative game in town, right? Like if people wanted to do high risk, potentially high reward investing with part of their portfolio, junior exploration was one of the go-to arenas that they played in. In the last 10 years, a huge number of competing speculative arenas have evolved. So now we have, just think back over the last 10 years and everything that's cropped up. There's been weed, there's been crypto, there's been AI, there's been NFTs, there's been meme stocks. There's been so many ways that you can speculate with your money that particular attraction that the junior space used to have for speculative money is no longer so particular. And so you mix that in with the gold, that metal prices are not exciting, and nobody cares about our sector. When it changes, it will change in a big way, I think, because the memory, these things, when they go really well. And we'll move on and talk about uranium, and hopefully uranium is charting the course, like providing the reminder of what an undersupplied metal market does. And so hopefully uranium will do that, and then it will chart the course for the others. But there's just not a lot of reason for people to move into mining stocks right now. And unfortunately, there's quite a few reasons for them to not.
And so, yeah, definitely. So the sector, the speculative sector has the market share has been reduced significantly because of all these other speculation plays out there. And for me, I'm going to give my bold view on this. So I think that, which I could be wrong, but I'm also not going to go all in on my bold view. So I'm going to hedge. I think that it's going to take something for gold to become like some form of crisis, for gold to become, okay, we need to be in this sector, because investing in, some of these altcoins or some of these weed stocks is not going to play out well for many people, and many people are going to lose a lot of money. And so my basis for that is, a lot of the factors that we discuss, but also based on just history. And I had the chance of interviewing Neil Howe on my channel, author of The Fourth Turning. And I'm currently going through his book, and I'm like, yeah, something's going to go down, and and people better be in some real asset. And so, yeah. That's kind of like my view, but that could be, 5-10 years from now. So, but however, I'm taking this time to position myself accordingly. So I do want to know for the exploration companies, there's a lot of jargon. There's a lot of things like that. It's going over my head, and I have to spend a lot of time to even understand a fraction of it, because you got these people that have been geologists for multiple years, and they're communicating almost a foreign language. And so for the average person that wants to get into, you know, the exploration companies or even the mining companies, what are some basic things that they should be looking for? I mean, if they don't want to be as passive, obviously you can buy a GDXJ or a GDX and be in an ETF and sleep well at night, I guess. I mean, but those get killed too, right? But But I mean, you've mentioned even in some of your work, I was reading on your website how you found, 10 baggers and companies that, if you do your due diligence, you can make money even in the current environment. So, what's your take on that?
Okay, so the mining space is there's two kinds of opportunity in the mining space. One kind is when the investing world, the larger investing world, sees deficits in metals or sees dramatic need for gold, like the kind of crisis that you were just discussing, and moves into metals. When that happens, then, the interest also goes into miners, and you can have these incredible price runs because of a bull market in metals. So that is one absolute opportunity in the mining space. And you can be being early, being wrong, they're kind of the same thing. So being too early in predicting one of those can mean that you wait a long time. But when a market like that gets going, like the one that we referenced, the 2004 to 2011, there were dramatic returns to be made in copper miners, in silver miners, in gold miners. We have uranium marches to its own tune. So then there's been bull markets in uranium where the returns are just out of this world. So when a metal market starts to go, you can own an ETF of mining stocks, you can own the biggest players in a particular metal that you like, and that absolutely works. And if you want a little bit more risk, but probably even more leverage to a rising market, then you step down to the companies that are building new mines or just about to start building new mines. So there's more risk there, but that's the potential when it works is for more return. Maybe they get taken out for that new mine because the big miner needs pounds for the future, things like that. So there's fairly clear ways of playing a rising metal market. We're not there right now. When it happens again, it's a wonderful opportunity for everyone because it's not that difficult. It is, but it isn't, right? You don't need to have a degree in geology. You don't need all of those things. You don't need to understand a different language to play a rising metal market with reasonably low risk. So that's one category of opportunity. The other category is the speculative side, right? And that's the junior exploration stocks who are looking to make new discoveries, or maybe they've made a new discovery and they want to demonstrate that new discovery is like big and real and meaningful. Those are the companies where you need to speak another language. You need to understand geology. You need to understand jurisdiction and capital markets and how they're going to raise money and who they're raising it with. And oh my goodness, there is a huge amount to try to understand. And then even when you understand all of that, like you say, I've done this for 15 years and I understand all of that, I still don't have a great track record because exploration is very tough, right? You're trying to find out what's underneath the ground, and we have geophysics and whatever, but you still don't know until you put the drill hole in, because graphite can look a lot like sulfides, and we only care about sulfides. They're the ones that hold the metal. Graphite we really don't care about, but the geophysics looks the same for both of them. So that's just one example. There's lots of ways that a drill target that can look like it's gotta be an accumulation of silver mineralization or zinc mineralization, and then it isn't. And that's just, it's science. It's science applied to the rock that we can't see through. So the ways that if you want to play that game, and it's an incredibly fun game when you get into it. I mean, I'm biased, of course, because this is sort of my world, and I'm a geeky scientist, and I love trying to apply science to rocks and then melding the economics into it. I think it's a really interesting and very real game. But if you want to play the game, the things that you need to do are, first, and this sounds like I'm just saying what everybody else says, but really start with the people. And when I say start with the people, look into their past, see if they've actually done it before. And by done it, don't just read a bio and be like, oh, they say they, successfully sold such and such a company. Well, what did that actually look like? Because anyways, so have the people actually done it before? And the easy test that I suggest people give to the CEO of a junior exploration company is, give me your clear plan to create value, or to attempt to create value. The rocks might steal your thunder, but what is your clear plan to create value for shareholders over the next 12 months? And it darn well better be a very clear plan. Which holes are you going to drill? Why are you going to drill them? Where are you going to get the money? When are you going to get the money? How are you going to manage the capital markets expectations for that money? What's your fallback plan if those drill holes don't work? Tell me what your plan is, because it's incredibly sadly common for these junior companies to just not really have a clear plan. And these are complicated things to do. You got to raise money. Raising money is not easy. Once you raise money, then you have all these risks that come with who bought your stock and what they're going to do with it. And, it's tough. So does the CEO explicitly give you a plan, detailed, with fallbacks, with clear goals for how they plan to raise money? That is sort of the thing. Now, if you don't think that you can understand such a plan to even know whether it is a good, clear plan, the other piece of advice that I give is don't try and do it alone. There's lots of ways that you can establish a bit of a team that you rely on in trying to assess junior stocks. So maybe that's like a physical group of people who you get to know in your neighborhood. Maybe it's an online group of people who you trade ideas with. Maybe it's a broker. Maybe it's a newsletter writer. Maybe it's a geologist who you meet at a conference who you can then send ideas to and ask whether he thinks they make sense. Find people who can help you. Don't try. I do it. I've been doing this for 15 years. I tell subscribers what I'm doing with my money. I still rely on others to help me understand whether an investment pitch makes sense. So don't try and do it alone, because it is a complicated world. If you can pick the right ones, it's amazing. It's like so fun. And I find it very real to make a whole bunch of money from having chosen the stock that had correctly identified an amazing drill target and drilled it, and then they turned moose pasture into a gold mine. Like, it's so cool when it happens. It's not easy. So don't try and do it alone, and ask a lot of management.
Yeah, that's some good advice. And so, Gwen, to get to uranium, I think to do uranium justice, we probably just need to schedule another time to come on and spend an hour on that. I do want to wrap up with, in terms of like some of the advice that you've given. Obviously, how a company plans to raise capital and what is their, plan B, plan C. Those are very practical ways. I do think that for retail investors, investing, if you're going to speculate, having a percentage of your portfolio, like Rick talks about this all the time, got a hunch, bet a bunch, and many people get burned. I've had someone on my channel say they lost a small fortune, by, having that hunch and betting a bunch. And so you have to really, if you're going to play the speculative game, you can't, invest everything and go all in.
Don't put all your eggs in one junior basket. Don't do it. The risks are too high. You're absolutely right.
Yeah. So, and that's how I've been able to play this game. So I went in 2022, early 2022, I pretty much liquidated like my whole portfolio, because I knew the market was coming down, and I was able to really educate myself more and start to rebuild. And so I've been in a rebuilding phase since then. So now I'm able to, throw some money here to speculate, throw some money here to actually, these are the actual solid companies. Okay, let me diversify, all those different things. So I've been in this portfolio rebuild. And people that, even experts in the space, I know some experts that have lost a lot of money in the mining sector. And so no one's exempt from losing money. And I think that, you have to be wise in how much you're going to invest and position your portfolio.
Absolutely. I mean, don't let yourself fall, especially when it comes to the speculative exploration end of this space. Never let yourself fall in love with a person like a CEO, a drill target. Don't let yourself fall in love, because they're exciting stories. These geologists who are, cutting through the jungle and finding a rock that's outcropped, that's laced with gold, and they're going to drill a hole. It's exciting, and it's easy to get too excited and then bet too much. And the way that you actually win in the junior exploration space is you identify 20 companies that you think have good management and good drill targets and clear plans to advance those targets. And then you put the same amount of money in each of those 20 companies. And maybe 4 of them deliver discoveries. Maybe only one becomes a phenomenal discovery, but maybe 4 of them deliver discoveries. Another, 12 of them are like sort of hold water. They make some progress towards a discovery, but maybe it isn't everything that was hoped, but it's still good. And then a few of them fail completely. They drill into graphite instead of sulfides. But the ones that work can work so well that they erase the rest. It doesn't matter what the rest do. So falling in love is a real risk in the junior mining space.
Yeah, definitely. And there's, even in that, you said 20 of the best companies. So you have to sort through, hundreds or probably even thousands of companies to even find the best ones. And so there's, I think Rick told me that it's probably about 1 in 3,000 or something like that make
a discovery that turns into a real asset, for sure. And I'm a bit biased, but I write a newsletter because that's what I spend my life doing, is assessing the hundreds of companies that are out there to try and find the 20 or 40 that I think deserve to have some investment because they offer that possibility. And there's others like me who do similar, who have a similar business model to me. They're geologists or they're mining capital markets people, and they do what I do. So having someone like me as part of your process, as part of your idea feed, it can be really helpful, because like you say, there's a lot of companies out there. And a bunch of them are just crap right off the bat. And then another bunch of them are they sound okay. They might sound good at first pass, but it takes some expertise to separate the wheat from the chaff, so to speak.
Yeah, and almost everyone believes in their company too. So that's that's another aspect. Well, Gwen, I thank you for coming on today. Where can people find more of your services? We had the Substack up, but if you want to give us the websites or whatnot, how to find you on X or Twitter, how can people find you?
The website is resourcemaven.ca. You can find lots about me there. Mining Maven Gwen on Twitter. Everything. Resourcemaven.ca leads you to all of the other platforms as well. My contact information is available there as well if anybody has questions that they want to send my way.
Yeah, thank you. I'll be sure to link to those in the description below. Be sure to go subscribe, check out Gwen's website, and if you're on Twitter or X, be sure to go check her out. So thank you for coming on.
Thank you so much for having me. This was a fun conversation.
Yes, it's loaded, but I'm gonna have to go
back. The best conversations always are.
Yeah. All right, take care.